Good evening, everyone. I'd like to call the Town of Monroe Pension Committee and OPEB Board of Trustees joint meeting to order. Today is Thursday, January 22nd, 2026. The time is 86:03 p.m. Please note that the meeting will be recorded and made available on the town's website in accordance with state law. We'll take roll call. Terry Rooney.
Here.
Steve Kirsch.
Here.
Jonathan Formicella.
Here.
Dennis Condon.
Here.
Frank Dutchess.
Here.
Joe Costa.
Here.
For the record, Christy Martinez and Jason Maurer, no call-ins, right?
No, but I do not see that.
Are not in attendance. For OPEB, Mike Capello, not in phone on. Ron Banowski.
Here.
And then Terry and Jonathan. And also we have Devin Francis, our advisor, Craig Hirsch from HR. And I think that's it. Okay, so review of the minutes. Is there a motion to accept the pension committee meeting minutes and voting record for October 23rd, 2025 regular meeting?
Second.
Any discussion? All in favor?
Aye.
No, that passes unanimously. Is there a motion to accept the OPEB Board of Trustees meeting minutes and voting records for October 23rd, 2025 regular meeting? Any discussion? Oh, second.
I'll second.
None? Any discussion?
No.
All in favor?
Aye.
Unanimous? All right, new business, we have our quarterly investment review through the fourth quarter of 2025. So I'm going to turn it over to Devin.
Wonderful. Okay, good to see everyone. Happy New Year. So on page 5, we have the governance calendar. That's what we start off with. And this is the quarter where we present our updated capital market assumptions, and then we do asset allocation modeling with the portfolio to help ensure that the portfolio is appropriately positioned to help you meet your return objectives. So our investment committee goes through the process of developing capital market assumptions on an annual basis. These are forward-looking assumptions. They're very long-term in nature. So what you'll see in this report is 20-year assumptions, because that's the type of time frame that the actuary is using. So they've got a very long horizon. Therefore, that's what we look at as well. We also do develop 10-year asset class assumptions. So, really what we're doing is we're looking at the economic and market environment, various, points of valuation, and a lot of data goes into this process. And then we develop risk and return expectations for each asset class across the board. So, we talk a lot at these meetings about, individual managers. Oh, so-and-so struggled against the benchmark, or so-and-so outperformed. But really, asset allocation is the primary determinant of how well your portfolio does. How much you have in fixed income and domestic equity, so on and so forth. So this is an important exercise, and this is also something that the actuary checks in with us on an annual basis. They ask us for our return assumptions and our inflation assumption, and they ask us to model out the expected return of the portfolio to make sure that it aligns with their return assumption. So there's some back and forth between us and the actuary just to make sure that, we're not each operating independently. So on page 7, this is a very wordy slide, but basically, this is as we look at, the kind of near-term investment outlook. Here are the factors that we're kind of, taking into account. So first of all, in terms of the changes for our forward-looking return expectations, they have, for the most part, come down compared to where we were last year. And you can see that if you flip ahead to the next page, page 8. So you see the 2026 column, and then for comparative purposes, we have 2025 and then the year-over-year change. And you can see, for the most part, the year-over-year change is modestly negative. And the reason for that is 2025 was a remarkable year in terms of investment returns, really across the investable universe. So everything performed very well, from fixed income to domestic equities to international equities to real assets. So you had very strong returns across the board, which means that valuations, or how expensive these asset classes are higher. So when you're starting with higher valuations, that means that you have kind of essentially less room to grow. So that's why you've seen that our, return expectations have come down across the board. The good thing is that when we look at results and if we concentrate on the S&P 500, you've heard a lot about the Mag 7, and how the Mag 7 have driven the market. So these, 7 very large tech names. Well, in 2023, all 7 of those names outperformed the S&P. In 2024, I think all but one outperformed. Last year, only 2 of those individual names outperformed the S&P broadly, and there was a broadening out of investment performance. So you didn't only have to rely on those Magnificent 7 names. We saw strong returns from elsewhere in the market. And the same was true for, sector returns. So rather than it just being IT that drove all of these really strong results, we saw strength from, industrials and materials and other areas of the market as well. So that broadening out should be a good thing for investors. And another good thing is that a couple of years ago, when we had really strong market results, most of it was from what they call multiple expansion, which is basically just like the speculative driving up of stock prices, and it wasn't related to earnings. In 2024, it was about 50-50, half from earnings growth and then half from that multiple expansion. And last year, the strength that we saw was about 85% that came from earnings growth. So again, that means that there's more, there is basically more justification in the strong market results rather than pure speculation. So that does bode well on a go-forward basis. But given valuations, we are not expecting such strong returns on, going forward. We continue to like international stocks. Right now, the kind of the global opportunity set is about a 64% US and 36% international breakdown. Your portfolio is just modestly skewed a couple percentage points more towards international equities because, we think the valuations are more attractive, and that was very helpful last year because international markets outperformed. And then fixed income, we think remains attractive, even though spreads are tight. So that means that when you're looking at corporate bonds or high yield bonds, the premium that you're getting over treasuries is not very high, but, credit worthiness is looking really good, and real yields are positive. So fixed income remains attractive. And then for clients where it's appropriate, we do continue to like other diversifying asset classes like real assets, which your portfolios do have exposure to. Alternatives like hedge funds and private equity that is generally not used in a municipal function. So all in all, we are not recommending significant portfolio changes for either the town of Monroe's portfolio or most of our client portfolios. So we think, folks that have listened to us thus far and had portfolios that are, broadly diversified and have exposure really across most of the investable universe, we think that in pretty good shape. Any questions so far?
It doesn't, just really quick, and this may be a very small situation. Page 8.
Yeah.
And you look at the breakdowns, the percentages don't necessarily add up in some of them. And it may be just that the increments were so low that it just didn't matter on the percentage. But I see like.
You mean like US all cap,
Yeah,
that's
there's
the
some of them,
point.
I mean, as you go down, like international developed equity, 7.9%, to 0.3, that would be
Oh.
7.8.
Probably
Yeah,
rounding.
it's a rounding.
It's a rounding
It's a
thing, so
rounding.
it's so minute that that was the closest.
Correct. Yeah, like
okay.
if
I
you,
just wanted.
yeah, no, it's a good observation, Terry. If you had gone out 2 decimal points, you would be able to see.
Is that an Excel spreadsheet? Something similar?
Probably.
Yeah.
Well, I just know, being somebody now that's been our district, Ron, and Heidi for many years, a couple of years now, and many years as council, if I had put that out.
Sure,
I
yeah.
would get that my numbers.
Yeah.
We don't add up.
Yeah, that's where
I just get very.
That could happen,
Yeah.
that could happen in an Excel document though, where they
Right.
don't.
Yeah. Okay.
the
I mean,
the
I'll look into
rounding,
the explanation, and it makes sense to me, it just comes out.
Right, yeah, no, it's definitely valid, because if it's, 7.85, versus 7.49, yeah, it might.
Anytime there's
one decimal
Which,
point.
yeah,
right.
that's good. I just wanted to.
Look at it,
No,
know
it's a
you
fair
got it.
question, absolutely, yep.
Not that well, it's not much.
Yeah, okay. I'm not gonna slip anything past you. Alrighty, so page 9, shows a snapshot of the funded status. So the most recent valuation reports that have been done were as of July 1st, 2024. So as we've discussed, your plans are extremely healthy, particularly in comparison to other municipal plans across the state of Connecticut. So you're almost at 100% funded, you're over 99% funded. The average is about 76%. So you are well above peers, and you also have a very reasonable return assumption of 6.75%. And I know that we've had conversations over the years with regard to whether or not you reduce that. We think the 6.75% is able to be justified. But the trend had been going lower, but it has kind of settled out right around that 6.75 or perhaps 6.5%, but not much lower than that. And then for the OPEB plan, your OPEB is also remarkably well funded compared to peers. I think the average funded status for OPEB plans, I believe, is below 50% in the state of Connecticut. So you being above 95%, that's great. And you have a 6.5% return assumption. And also the fact that, these numbers are as of 2024, and we've had really strong market returns since that time as well. So the funded status is probably even better now. So if you flip to the next page, this is slide 10. This is the output of the asset allocation modeling. So your portfolio is shown in this bright blue line. So these are the current asset class exposures that you have. And you can see that that models out to a 7.3% expected return. So again, if we keep in mind that actuarial return assumption of 6.75%, we think that the current allocation profile can justify that. We've shown you 2 different portfolios just for comparative purposes, adding 5% to fixed income and subtracting 5% from fixed income, but we think where you are right now, that 70-30 profile is appropriate. And then page 11, Ron, this page probably looks familiar to you. This is what Stefan usually requests from us. So we just started throwing it in the report. So this is what the actuary is looking for. They want to see all of our asset class return assumptions and then what the long-term dominant. So bottom line, we think the portfolio is appropriately positioned. We don't have any recommendations for change, and we think we should be in pretty good shape with appropriate diversification. So any questions about any of that before we look at the capital markets? Okay. So page 13 is where the capital markets overview begins. So if you look at the graph, the line graph on the left-hand side of the page, these are the results for kind of the biggest indices. So you can see a really strong return for all areas. So emerging markets and international developed markets both returned more than 30% last year. S&P 500 was up about 18%. The Russell 2000, which is small cap stocks, up almost 13%. And then bonds, which are, kind of your safety net, supposed to be a very conservative, downside protector, up over 7% for the year. So really strong results across the board. What's interesting is that if you, pay attention to the headlines, you may have heard reference to a K-shaped economy. There's a big, differential between how Wall Street is performing and how Main Street is feeling. So it's kind of interesting. If you look at consumer sentiment is at almost its lowest level ever. So consumer sentiment is worse than it has been 96% of the time. So that means people are feeling that the economy is very poor. However, there's something that's called the misery index, and that's a combination of inflation and unemployment. The misery index right now is better than it has been 75% of the time. So there's this disconnect between these figures. And if you pay too much attention to the market results and what Wall Street is saying, you might be overly optimistic. But if you pay too much attention to the consumer sentiment piece of it, and what Main Street is saying, you may be overly pessimistic. So I think it's important to have a balanced view and a balanced approach. One of the things obviously that is dominating the headlines has been AI. And we get, a wide range of questions from how do I make sure that my portfolio has exposure to AI to, oh my gosh, I'm scared of AI. How do I diversify away from it? And, we think that our clients' portfolios are appropriately positioned with enough exposure to participate in the trend, but not overexposed to, kind of be out over our skis if we do see a sell-off. And the way that we get that appropriate diversification is by having a little bit of an overweight to small and mid-cap names over large cap, and then also having exposure to international. So if we look here on the right-hand side of page 13, this shows that of the S&P 500, almost 40% of that is directly related to the AI space. If we look at the Russell 3000, which is all cap, that's a broader index and the amount is lower. If we were to specifically look at the small cap index, it would be even lower than that 34%. So having exposure to small caps means less concentration in that AI trade. And then overseas, so, again, if the US market is about 40% tech within the large cap space, the international developed markets are only about 10% tech. So by having exposure to international, you again diversify away from that big tech trade. So we think it's important. We want to participate in the trend, but we don't want to be overly reliant. On page 14, one of the things that I think is interesting is on the left-hand side of this page. So I talked about valuations. So, if you see these bubbles that are up near the top of the gray bar, that means that valuations look very expensive relative to history. And you can see not only does the S&P 500 look expensive, but after a really strong year last year, international stocks also look fairly expensive relative to their history. But what doesn't look so expensive is the Russell 2000, which is small cap stocks. So those small cap stocks have been a drag on your portfolio's performance. They've been kind of a source of a headache, and we've talked about some of those managers, but those stocks are poised to have more potential for growth because the valuations are much less expensive than other areas.
I think they've poised there for about 3 years.
They have, yeah, they've definitely lagged for a pretty substantial period. Yeah. And, when we look at, we've probably talked as a group about the cyclicality of market leadership from a geographical perspective, because a lot of people are frustrated by international. Why do we have exposure to international? The US always dominates. And then you actually look at the chart and it's like, oh no, there have been periods where international has outperformed. It just hasn't happened for a while. So we have that recency bias. And the same exact thing is true in large and small cap. So I think large cap has dominated for the past 14 years or so, but prior to that, small caps were ahead for 11 years. So, you have these kind of long cycles of outperformance, but you're right. They've definitely been a headache over the past couple of years. So page 15 shows the asset class results for the full calendar year, and then the circles on those on that bar graph represent the fourth quarter. So, the biggest visual takeaway here, I think, first of all, is the significant outperformance of international last year, both of those indexes over 30% for the year. And then the other thing is that everything is in positive territory. So for a diversified portfolio that has exposure to most or, maybe even all of these asset classes, you have really strong results as a combined portfolio.
You look at the commodities in the fourth quarter, 5.8%, which is pretty significant. If everything we're talking about in terms of raw earth, doing some onshoring with steel and other things, that I would think would be an area where we're going to see continued strong performance.
I would think so. The commodities market has a tendency to be volatile. So, and there are also so many different areas of the commodities market. So you have oil, you have natural gas, you have precious metals, you have
Natural gas isn't volatile.
yeah. So, but yeah,
Check the snowstorm.
yeah. I do think you're right, Frank, is that, we should see strength.
I think we're seeing approaching new highs in gold, silver,
Mhm.
your raw earths, rare earths, if you will.
Yeah.
Okay.
Yes, absolutely. And you have, the way that you have exposure to that area of the market is through the Principal Diversified Real Asset Fund. So that fund has exposure to commodities and natural resource equities, and then they also have infrastructure, and they can overweight or underweight those specific areas based on, you know, the opportunities that they see. So it's a very active approach. So let's flip ahead a few pages. I always like to pause on page 19, to just show the importance of, having diversification. So, you know, what you see here each calendar year is in column, you have the best performing asset class of that year at the top of the column, all the way down to the worst performing asset class of that year. And there's no rhyme or reason and no discernible pattern, but what you do see is that this balanced portfolio, shown in the orange box, it's always kind of middle of the road. So by having an appropriately diversified portfolio, you help reduce the overall volatility, and that return stream is smoother. And that will be helpful from a, you know, pension contribution perspective, where you don't have these wild swings from one year to another, so that contribution level can remain a little bit. And then the last thing that I wanted to just pause on page 20, is, and I know that the font is super small, but if you look at the S&P 500 and just look at the 5, 7, 10-year, 15-year results for that index, it's above 14% over all those time frames. So that's an annualized return of over 14% for the last 15 years. So that kind of puts things in perspective as to why our return assumptions have come down. It would be great if that type of performance continued, but it seems like it's a little long in the tooth here, and we are not likely to see returns quite as robust as that on a go-forward basis. So I think that is just kind of staggering. If you think about, you know, the long term, like let's say you're looking at your 401k and you put in a return expectation, you know, 7% is really the kind of basic standard for a return expectation. So to think that we've gotten double that over the past 15 years is pretty remarkable. Any questions about capital markets before we look at the portfolio? Okay. So page 22 is the town plan. So this plan ended the calendar year with just over 17 million in assets. Page 41, you don't need to flip ahead, but 41 is the Board of Ed plan, and that ended the year with just over 18.4 million. These two portfolios are positioned in the same way. We have the same asset allocation profile, same underlying strategy. So we'll use the town plan as a proxy just because it shows up first, but basically same thing is said for the Board of Ed plan. So you can see over the past year that the portfolio was up 15.4%. And on a fiscal year to date, so the last 6 months of 2025, the portfolio was up 7.3%. So over the course of that 6 months, you already exceeded your return assumption of 6.75. So really, really strong absolute results. You can see on a 1-year basis, we lagged the benchmark pretty significantly. I read an interesting statistic that last year was the second worst year for active managers since 1926. So going back 100 years, it was the second worst year for active managers. So it was tough for a lot of those managers to keep pace, but you look longer term, you're in line with the benchmark and ahead of that 6.75% return objective across all time frames. So that's good news. And in terms of the asset allocation profile, we already talked a little bit about that on the bottom right of page 23. In this table, you can see that we have the minimum allowable allocation and the maximum allowable allocation. That comes from the investment policy statement, and this chart is in every report. So you know that we're paying attention to it. You have record that you are certainly in compliance with that. And then on page 24, you can see all of the underlying strategies. These are the same strategies that have been in the portfolio for quite some time. We don't have any recommendations for changes at this point. But if you flip ahead to page 27, you can see that a few of the managers are on either discuss or watch status. So I'll start with the watch status. We may have discussed this last quarter, but Conestoga has had some really significant underperformance. The magnitude of the underperformance is noteworthy. So our research team is kind of re-underwriting the strategy, making sure that they are adhering to the sell discipline, that they're not getting married to these stocks which are poorly performing. And they also are in the midst of a well-planned portfolio manager transition, but a transition nonetheless. So one of the main PMs stepped away from his PM responsibilities at the end of last year. He is serving an analyst role for 6 months to make sure that the new team is up to speed. But anytime there's a transition like that, we just look at attention. And then the Diamond Hill mid-cap strategy was just placed on discuss status because Diamond Hill is undergoing the transaction. So they are being purchased by First Eagle Investments. In terms of our knowledge of the Diamond Hill team and First Eagle, it seems like a good fit. We think this did go off without a hitch. And the Diamond Hill team is going to be allowed to continue to operate the way they have been. But again, that's something that we want to pay close attention to. And then the principal diversified real asset fund is undergoing a benchmark change. So they're removing tips from their benchmark. And again, this is not something we have an objection to, but you know, it's a significant change in the portfolio. So we'll keep tabs on it. And actually, I will note that even though tips are being removed from that principal fund, you do have exposure to tips directly. So it's just a small allocation, but you have a 2% exposure to the fidelity. So we already have that tip exposure, and we think that change should be fine as well. So we've got some updated memos about those three either watch or discuss statuses, but no recommended changes at the current juncture. And then, you know, we've got plenty of additional information on the following pages about all of the underlying managers and the return streams. You know, fixed income has been additive. Domestic equity has struggled, and that's due to the small cap exposure. International equity had a really strong year in absolute results, up almost 30%. A little bit behind the benchmark last year, but ahead on a longer term basis. So everything is chugging along just fine. And we're suggesting something. So I already mentioned the Board of Ed plan, same underlying investments. Again, a little bit more money in that pool, 18.4 million. And then if we scoot ahead to page 56, you can see the OPEB. So we ended with 3.6 million in the OPEB pool at the end of the calendar year. And because nearly this whole portfolio is passively managed in index funds, you can see that the performance is much closer to the benchmark. So for the 1 year, the portfolio is at 17.2%, 3-year annualized basis at 14.5%, and then you can see the long-term results. So again, keeping in mind that actuarial return assumption of 6.5%, the portfolio has exceeded that across all things. And then the underlying strategies in this portfolio can be seen on page 58. So the only place where we have active management is on the fixed income side. We've got a traditional manager through Baird, and then again, a managed manager through BlackRock, and then the rest of it. So again, no changes recommended for that. Any questions? No. Markets did all the work.
So this past week, there was argument going forward about the removal of government from the Federal Reserve and Association of Economists, professors really wrote authored an amicus brief saying that if the president is allowed to remove her as a governor, that it would essentially throw the United States into a recession. And I think that they probably have a political axe to grind of their own personal feelings, but is there any concern with the industry about with this Supreme Court decision?
Yes, yes. I don't think that it would throw the economy into a recession, but, there has always been a point of pride about Fed independence and, that the Fed governors don't bow to political power and political pressure, and that, the government does not get involved in Fed matters. And so if Lisa Cook is removed, based on the orders of President Trump, it would simply be a blow to Fed independence. The fact that Jerome Powell was allowed to stay on throughout and serve out his term as chair, I think was good. That was called into question many times last year. And every time that headline kind of hit the ticker, you would see markets pull back. So I think if she is removed, if the Supreme Court does decide in that way, then I think we would see a market reaction. It would probably ultimately shut it off, but, I think that there's a lot of value to the Fed's independence, and if that starts getting chipped away at, I think that it does signify a problem. I don't think it's going to ruin the economy, but I do think that.
Solicitor General salary gave you the example for the things that they asked about it was that the stock market has like 3 great days, like after the ability to conquer this too. But I just think this in how the industry is fond to
Good question. There's a lot going on, a lot of uncharted territory. Yeah.
questions.
Yeah. Yeah.
We do have, SPDs to discuss, so I don't, if you will knock out, I'm more than welcome to.
I will take that up and I'm
Okay.
great to see everyone. Reach out if you need me or have any questions.
Okay.
All right, thanks. Bye.
Thank you, Dennis.
Thank you.
And there's no one just on with
Okay, so we do have copies of our summary plan description for the town and Board of Ed. I know during our last meeting, we had put off accepting them because there were some changes that I proposed, and what you see here are the comments, I guess, remaining comments from the attorney to some of those suggested changes. That we just have to get back to her and clarify. So I don't know if everyone just wants to kind of peruse the comments and let me know if you have any comments or objections. Do it that way?
Sure.
We're focused on the red.
Yes, the attorney is the red, RO3 is me.
Which suit the 230.
Mhm. You're welcome.
Okay.
Specific responses from the things that you wanted, I guess consensus from something about.
I mean, the one thing is we mentioned like there's say on page 6 with the mention of the DC plan or the money purchase plan. I think Ron had made a previous comment about that. I would like kind of clarification, but wherever that is mentioned, I want it to be mentioned the same way throughout the document.
Do you think that, so the DC, do you think we should be mentioning the DC plan? Because so just from a logistics standpoint, anyone who's eligible for the defined benefit plan, the plan's frozen, so no new employees are eligible. Anyone who's not eligible is eligible for the DC plan, the defined contribution, plan. This pamphlet will never go to anyone eligible for the DC plan, so I don't think there's any reason to mention the DC plan in the summary plan description at all. That's my, I think it just may get confusing for them. And I think you agree with that, right? I know we briefly.
For one of the rare times I do.
Wow.
No, yeah, there's no.
So would
there's no
your
point. They're
recommendation
not-
be to
The
just-
two will not intermingle.
Yes, and I think it would just get confusing to people who are handed this. So, and I'm gonna use the example, you know, well, it could be any example, but you know, somebody in the, clerical who's eligible for this plan has been here since 2012, doesn't need to know, you know, knows that they can contribute to the DC plan with their own fund. The first,
The 457.
yeah, 457.
Yeah, but they
If
will
they
not
can
be in
defer.
the 401 plan. with-
No, but they're already in the defined benefit and
If we want to get the- or when you express it in that's where
I don't
it's
think
there.
that piece was, spelled out to her, but I think. With
It's not relevant to the individual that's receiving the explanation. And I assume there's an explanation of those to the individual, like, oh, this is what you're eligible for, this is what you're eligible for, we're only giving them the thing that they're actually eligible for.
this won't go to new hires, because they're not eligible for it. So it'll just go to existing employees who are eligible for the defined benefit.
And I think it probably came from an amendment where when we changed the plan and ended it.
Maybe,
And specified the fact that, hey, these people are no longer eligible, but the people coming forward can go from the defined benefit fund, but now can go to the defined contribution. So there's not really reason, but the ending of the fund. So there's not really reason to the whole document is essentially done. There's no reason to provide relevant information to
That's
individuals that could be more confusing to them, right?
Mhm.
yes,
Because I think Rebecca kind of embarked on this project to make it less confusing.
that's,
true.
that's my thought.
So Ron, I think on this one, we providing no cap to her. Just adding that this is just not applicable any longer and just remove it.
Okay. You're on page 6 right now, right?
Yeah.
So yeah.
That's where we mentioned defined contribution.
Okay. what I was gonna do was tell it, any reference to the defined contribution plan should probably should be removed.
Okay, I agree with this a little bit. I'm on page 18. The question was, who is divided into the. Now, I see the comment back is the town, the country plan. But that's not suggesting any change in the language, is it?
No, because right now we have defined the plan administrator as the pension committee. But for the most part, Craig and Ron are managing all of that.
Well, I guess what I'm saying is, if I look at, you have the question.
Yeah.
The comment came back, based on that comment, was there any change being made on item 28? Or is it just a comment? Yeah, it's just a clarification of rules. It's not a clarification that's being put into the plan. Okay, so several of those, as I go through them, they're just clarification back to the committee. Yeah, okay. So,
Yeah, there's a Board of Ed and a town, we're gonna review the town, so if you look at the very first page, one says for town employees and one says for Board of Ed.
I'm looking at one.
Yeah.
The UFO.
We're reviewing the town employees.
Which one do you? Okay, you want the board that one? I believe they're gonna be the same.
They are just their certain.
There are some minor differences, but I think most of,
Yeah.
And on page 22, I added Jason Mauer's comment. I had redlined a lot of the instances that he referred to throughout the document, so she accepted a lot of changes that we don't see, that address, the flow and of the information throughout all of it. Yeah.
Were there any other?
so I have another, now that I'm looking at it again, so on number 6, so page 6, number 6,
Mhm.
the chart there specifies all the bargaining units for the town, which that covers
Where are you on?
page 6, number 6, on the town.
I'm on the wrong one. I'm on the wrong back. I'm on the one you took the town thing, yeah.
So there was an amendment to the plan that said, any employees hired prior to July 28th, 2017, that they weren't, that was the cutoff in the plan amendment. The reality is in each of the collective bargaining agreements and for non-union employees, the dates in that chart are the dates that drive it. So I think that gets confusing because you got one date saying one thing, but you got the dates in the collective bargaining agreement saying something else. And the collective bargaining agreement is what's going to dictate. So I think all we need in number 6 is the little paragraph above and the chart, and that's it. So I think it gets confusing.
So you're saying take 2015 new hires in the chart?
Yes.
So get rid of the except down to the following date.
That whole first paragraph.
Makes sense.
Anyone?
Specified for union.
Those that
You had to be there before.
that's the population in town hall. That's it. So
There's no employee like fall outside of the school.
Or union.
that are eligible for the pension, correct?
You sure?
Yes.
Okay. So that first paragraph can be removed.
what I would like to do is make sure, you know, as long as the, attorney is in agreement,
Mhm.
I would like to remove that. Because I think it would remove confusion. But. And but we could, I guess I can get back to you, you and I can discuss it before.
Yeah.
I don't know if the whole board wants to be involved, you know, as long as I get her approval.
We've got to make sure we're like the language, I believe no yellow clear about the assessment for, and I know from the amendment regarding regularly working schedule of 30 hours. Or these,
Yeah,
yeah,
you know, the only other bargaining unit we have are police, and they're not in this function. They're in you know, state function.
Okay, so the question is when and how do I become a participant? And the answer is you don't.
You're either a participant or you're not.
Yeah.
You know, the plan's frozen, so it's, yeah.
yeah, again, going back to the, we wouldn't handle the thing one. Or
Yeah.
Already.
And just, you know, on the board side, it's the same thing. It's different bargaining units, but it's the same thing. No new employee is going.
Okay. Yeah, that simplifies it. For sure.
And I don't even think that paragraph's on the board. You don't?
yeah, it's gotta be,
No.
you became a participant, or, you know, you
Yeah.
have to do this.
I don't know if it's that important, but it could be something to do with that is how, you know, how am I a participant? I don't even know if that's relevant. Participation, eligibility, something, I agree with you, John. Eligibility is good.
Good. I know you said that you can start. You're having that, someone, you know,
That person was hired before those days, so. That's. Why don't we leave it like this? If we keep it, we'll see if she's on par with meeting the title eligibility, or see if she's okay with moving the whole stuff.
Okay.
What are no other big ticket items for you?
No, I think, I mean. There was one where we said what's et cetera, and she went into that, explaining what else it could be. So she didn't add anything, so. So I found page 8.
Oh, is that where she described a person going, say, from the Board of Ed to the town or vice versa? We have had that happen before.
Well, yeah, because the question is what actions qualify for service, and she had sickness, disability, or layoff, et cetera. And I was like, well, what is et cetera? So I just wanted to be sure. Too. You know that one?
What was page 17?
No, page 10,
Page
17.
Page, yes,
So there's changes to that. I don't think it's taken out altogether. I don't know if she will, but.
I think that needs to remain. I think the reference to section 6 should come out. But the rehire date, like if somebody leaves and was in the pension plan, and we actually had this happen on the board side. I don't know if it's ever happened on the town side, but they were eligible for the plan, they were in the plan, they left. They got rehired back. They're not eligible. They're not. They're eligible for the defined contribution fund, not this plan. So that probably should stay in because that could pertain to somebody. The reference to the plan though, Steve, I agree, should come on.
Okay.
Yes, yes. Contribution from, you need to keep it in the terms. So it's probably gonna remain in on page 10.
11.
And I think it may be in an example.
Okay, so it's gonna be out for besides. Okay,
Mhm.
Um. You know what, I will ask her about them. Because the way it's referenced in 10, I don't think it needs to be defined. It just probably will end up confusing people more.
Page 10.
Yeah, if it remains, so page 10, the first paragraph, the last sentence will probably remain. If you're rehired, you have the opportunity to participate in the town's defined contribution plan, but will not be permitted to participate in the plan,
Yeah.
in the plan, which is the, defined benefit.
Okay, so in the example on page 11, she also uses for the back. The back is
Hmm.
to be walking. To be keeping.
makes sense.
If anyone doesn't have any other comments, are you good? Sounds
No problem.
okay, so then I think we'll go back to her. Just to resolve some of the outstanding comments. Do we have to vote?
I don't know I think if there's a consensus to move forward with the changes, I think that's
Okay. So then
adequate.
we'll finalize all the edits, get clean copies, and then they would go on record here, right? Be filed as,
Yeah, again, we're not changing the plan. This is just the summary plan description of the plan,
Right.
so,
but I know that there's people waiting for a
Yes.
copy of it.
yes.
Participants in the plan are waiting for copies, so we just need to wrap up all the editing, finalize, and then I think town hall and first selectman office, we have copies on them.
Yes, I think HR will, and HR at Board of Health.
Okay. Everybody good? Motion to adjourn? Okay. Thank you.
Thank you.